You're going to be in the ES or the S&P 500 into perpetuity. If the market goes up, you're going to make money. If it continues to do what it's done over the last 100 plus years, you're going to make money. The ES is the best way outside of the SPY and probably better than the SPY, in my opinion, to do the collar strategy. We want to mirror the S&P 500. It has went up 100% of the time over any 20-year period. So if you want to do the S&P 500 long term, you want to do it in the ES or the SPY, but primarily ES in my opinion, because you're using your capital more efficiently. And it's a little bigger than the S&P, the SPY. So you get a little bit more umph. Yes, you can feel it more to the downside as well, but that's why you're using a collar strategy on this. When I'm talking about this ES, I am not talking about doing a cash secured put. Very rarely will you do it in a cash secured put. It's just too big. You're going to have a really big account. I'm not talking about a Bionic Bull. Very rarely would you do a Bionic Bull because it's too big. I'm not talking about even a covered call because it's just too big at times. But if you do the collar with the ES, I think it's the best underlining out there to do the collar in. If you have an account size that's at least 25K. You can do it with something less, but just to give yourself some cushion, give yourself some rope, having 25K is going to be ideal. You're not going to use that much. I'm going to show you this right now. The market goes up, like I said, 100% of the time of any 20-year period. I'm not cherry picking the 20 years. You can pick whatever 20 years you want. It's gone up 94+% of the time, a little over 94% over any 10-year period. It's over 80% for any 5-year period. I think it's like 84 perhaps. That, to me, is screaming, use the S&P 500 as your core underlining that you trade. If you do not want to realize losses, you want to have a really solid probability that's going to come back and you want to be better than buy and hold, the collar strategy on the ES or the SPY is ideal. Why is the ES better? It's a little bigger and it can work for anyone capital-wise that has at least 25, even a little less than that. The SPY does not work for everyone. You have to have portfolio margin for the SPY to even be somewhat comparable to the ES. And most people don't have portfolio margin because they set it at this time, in this day and age, they set it by a certain dollar amount in your account. If you're using Thinkorswim, you have to have at least 125 initially and maintain 100,000. If you're using TastyTrade, you have to have at least 175,000 and maintain 150,000. I don't think it should be about money in your account because they don't do that for the futures world. They don't have that ridiculous regulation, in my opinion, in the futures world. So that's one of the reasons why the ES supersedes the SPY. Another reason is that the ES has better tax treatment. It has what is called 1256 tax treatment. 60% long-term, 40% short-term on your capital gains. The SPY is completely ordinary capital gains rate. So if you have the highest tax bracket, 39%, that's what you're paying. Another thing that benefits the ES over the SPY that you don't have to worry about any kind of wash sale garbage. It's clean. And it's just as liquid. Nothing's more liquid than the SPY, but it's just as liquid. It's liquid enough, significantly enough, that you can get in and out of it whenever you need to. Even in really stressful periods of time when the market is dropping a ton like it did in April for that liberation period. You're going to be able to do what you need to do. Now, let's walk through the process of setting it up because there's some nuances to it.
Sorry, O'Brien. Is there an advantage on when we can trade like after hours on the ES versus
So I didn't even mention that, Ricky, but that's another advantage to the ES over the SPY. You know, some platforms you can buy SPY over after hours, but you can't trade the options, but you can't do that with the ES. That if you work a full-time job or if you just wasn't able to adjust something or do whatever you wanted during the day, you can do it in the evening, and it's just as effective. The options are still good. There's so many positives to the ES. If I don't write it down, I'm gonna forget some of them. Okay? All right. So what I want to walk through is the steps. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. The first step you're going to do on Thinkorswim or TastyTrade, we're doing it on TastyTrade right now, is you're going to go to the option chain and you're going to go to 7 days to go. And what I want you to do first is buy the future at the top. Okay? You're going to buy the future, and you're not going to send it or anything like that. You're just setting it up. And TastyTrade is a little better to do this than Thinkorswim. You got the future down here, as you can see. Then what you're going to do is set up the options the way you want it to be. So let's just say I think it's going to 6,400 again in the next 7 days. So I can sell this 6,400. Then what I want to do is buy a put for less than this. For me, usually I want to collect at least $25 at the very least for that week, so I can manufacture $1 dividend every 28 days or every month. It's something I'm going to be talking about in a retreat, that you want to do it at 10 points lower than what you sell the call for. So in this case, I'm going to go to the 23 strike. I'm going to buy a put for around the 23. And I just say I did it here. And so you can see that this is giving me $500 in extrinsic. It's jumping all around. It just said 500 a second ago. And then you have to do the math before you send a trade. And it's some nuances to sending a trade. You have to do the math. And so what the math is that this is $50 a point. So you're going to have to take this number on the call side, and you're going to subtract the last price from this call. So you're going to take the 6,400 and you're going to subtract the 6,372 from it, which is going to give you 28 points to the upside. You're going to take that 28 and you're going to times it by 50, because that's the denominator. It's $50 per point. So that's going to give you $1,400 to the upside, plus the extrinsic that you can get here, which is jumping around at, say, 500. So the most you can make on this trade is $1,900 to the upside in the next week. That's real money, right? To the upside, $1,900 to the upside. Now, you have to do the math to the downside, just to see how much you can lose, not realized, but how much you can lose over the next week, unrealized loss. You take this 62.95 and you subtract it from this. Okay, so 62.95, and you're going to subtract it from the 63.72, which is 77. So 77 times 50 is $38. $38.50, I should say, not $38. $38.50 is what you can lose, and 1,900 is what you can make, basically. Okay? And so keep in mind that this 38.50 is unrealized. That's the most you should lose going forward, even if this thing drops 20, 40, 50%. You're going to be in the ES or the S&P 500 into perpetuity. If the market goes up, you're going to make money. If it continues to do what it's done over the last 100 plus years, you're going to make money. Every 10, every 5, basically every 10 and 5, but 100% of the time, every 20 or more years, you're going to make money. Any time frame, any 20-year period. So this is some of the nuances you have to know about putting on this trade. You have to know that it's not going to give you the max profit. It's not going to give you your max loss. It's going to tell you your buying power. I said you need $25,000 to do this trade. Obviously, you can do it for a lot less. It's probably the worst case scenario you're going to have is about $8,000 to do this trade. But you still want to have cushion.